Have you been checking your stock portfolio lately? If you're like most physicians I know, then it's been a bit of a white-knuckle ride through the recent volatility with all the uncertainty surrounding the market and all of the tariff questions and concerns that keep coming up seemingly day to day. Traditionally, bonds would serve as a safety net in these times of volatility, but concerningly, they've actually begun to correlate with stock market returns. So instead of serving as a hedge for downturns in the stock market, they've actually been going down on days when stocks are going down as well. In today's video, I want to discuss how mortgage notes can help to provide that stability in your portfolio and also continue to produce income, especially while we're dealing with a lot of economic uncertainty and ups and downs in the market. Many physicians are strongly invested in the stock market through 401k accounts, and this includes both stock and bond allocations. And this can cause a lot of concern, particularly when we do see correlation between the stock market and the bond market rising, as traditionally when we would see that bonds would be a protection against stock market crashes. Now, with bonds and stocks tending to move in parallel, there can be significant swings in your portfolio day to day when we are seeing times of economic uncertainty like we're in today. Data from JP Morgan has shown that over the last several years, there has been an increasing correlation between stocks and bonds. And so this safety net of relying on bonds to protect you from stock market downturns has been shifting and can no longer be relied upon. This is important to consider, especially as this was often kind of a hedge in the classic 60-40 stocks and bonds portfolio. And because of this, it requires a new mindset or thought process regarding how you're going to allocate your assets to protect yourself from volatility. A recent example was when broad tariffs were announced by President Trump, there was a stock market sell-off. But what was more concerning was there was actually a commensurate sell-off in bonds, which caused bond yields to rise. And again, this is the opposite of what you want when you're trying to use bonds as a safety net or a hedge against volatility. So this rise in correlation is no longer a protective factor like it would have been maybe 10, 15 years ago in your portfolio. And the traditional teaching is that you should be diversifying your portfolio. But unfortunately, when correlations rise like this actually defeats the purposes of that diversification. So you need to look outside of the traditional teaching if you really want to achieve diversification. So another issue is that bonds also do not pay very good yields currently. Particularly the most commonly used type of bond will be Treasury notes. And right now, 10-year US Treasury notes are yielding just over 4%, which if you look at current inflation data is just barely beating out inflation. And that's not even accounting for taxes if you hold these in a taxable account. Treasury bonds with their relatively low yield would be private bonds or things like junk bonds, which do carry higher yields, but of course they come with higher risk of default and that they may not pay you back. So why then might you want to consider mortgage notes? Well, mortgage notes can effectively take the place of bonds in your portfolio. They certainly can offer higher yields, and that is a benefit because they can help you to beat inflation even after accounting for possibility of taxes. Now, of course, you might be wondering, well, doesn't that increase my risk? As you told me previously with bonds, the higher yielding bonds tend to carry more risk. And this is true in some degrees. So of course, there is higher risk when you're investing in an individual mortgage note, but if you go through the process and complete proper due diligence and screen for good assets, there are many ways that you can lower your risk with these investments. So unlike stocks, which are affected by market sentiment, or bonds, which are very sensitive to rates, mortgage notes are a little bit more stable. The borrower is contractually obligated to continue to pay you a fixed amount each month, and that doesn't vary based off of market conditions. As long as they have the income available to them to continue to make that payment, market conditions really shouldn't play a role in your ability to receive that income. Also, the yield is substantially better in most mortgage note investment opportunities. As we said, a 10-year treasury is yielding around 4% at this time. And with mortgage notes, you can expect to get rates in the 7% on the very low end, but more often in the 10 to 12% yield range. Now, one point I would like to make, we talked about how bonds in particular can fluctuate as interest rates fluctuate in the market. Mortgage notes are not actually immune to this. So if rates go up, the value of your note will actually drop. Now, if rates drop, actually the value of your note can rise. However, you're not dealing with an asset that's sitting on a liquid exchange where people are trading it hundreds or thousands of times per day. So you do have a little bit of ignorance is bliss type of scenario where you do not have to see the day-to-day fluctuations. Now, this is a benefit because this can actually keep you off of the roller coaster of emotions that you might experience during stock market ups and downs, right? So that's another benefit here that can prevent you from panic selling like is very common during market downturns or market stress. Now, it's very similar actually for bonds. So those losses that you might see during market fluctuations with bond prices are really just paper losses, because when you purchase a bond, you are assuming the bond goes to maturity and continues to pay and doesn't default. You are guaranteed to receive payments at the yield that you purchased at. However, this decrease in value, these big paper losses, can cause investors to run into trouble. In one analysis of bond investor behavior, bond investors earned an average of negative 0.5% to 4.56% on the Bloomberg U.S. Aggregate Bond Index over a 30-year period. This significant underperformance is suggestive that a lot of emotional trading occurs within the bond space and can significantly affect the returns of bond investors. Another issue that bond investors might run into is they're often using margin to trade these bonds. So that's a type of leverage where you can basically borrow money from your stockbroker to purchase more bonds, or you can take loans out against your bonds. And what can happen is if we have significant market fluctuations during down days or times of volatility, those paper losses, while they really shouldn't actually hurt your returns in the long run, they can lead to a margin call where you will actually get called up by your broker and say, hey, you need to pay us X amount of dollars, otherwise we're going to forcibly liquidate your assets today. Now, another benefit of private mortgage notes is that you don't have this day-to-day fluctuation, and therefore you're not going to be at risk of getting a margin call, even if your note is technically fluctuating as there are changes in the interest rate environment. Now, you may be wondering, well, what about the 2008 global financial crisis, which was predominantly precipitated by subprime mortgage loans that defaulted and caused a cascade of issues? Actually, during that time, in 2008, well underwritten notes did tend to continue to perform. So during that time, those that were underwritten by government entities such as Fannie Mae and Freddie Mac only saw a 6.2% delinquency rate, even at the height of that global financial crisis. So the vast majority of loans continued to pay during that period of time, especially those were not in the subprime mortgage category. And since there has been significant regulation since that whole debacle, most mortgages are much more safe and secure than they were in the past, as borrowers have to meet strict ability to repay requirements now to qualify for a loan. So without those day-to-day portfolio swings, that can decrease some of the emotional toll you might experience during times of market volatility. Another benefit of notes is that they are relationship-based, not necessarily algorithm-based, like a lot of the larger stock and bond asset trading platforms or trading activity is. So with mortgage notes, you can actually develop a relationship with a specific borrower, and that allows you to actually get to know the individual and the story behind the note, and it's not just a faceless counterparty on the other end of your trade. In an example, so say you purchase a $100,000 first lien note at an 8% yield. That's going to produce about $667 of consistent monthly income. On the flip side, say you went out and purchased a bond fund at a 4.2% yield. Now, in a given day, that might lose anywhere from 3, 4, 5, maybe even 10% of its value. So that bond might be producing $4,200 worth of income in a year, but if you see a 10% downturn during that year, your paper loss is going to be $10,000. And then there's that lack of security. You don't have a hard asset on the other end of that trade to kind of give you some of the confidence that actually mortgage notes can allow for. Another benefit to notes versus bonds, for example, would be that there are actually some ways that you can decrease your risk and address issues that might come up with the loan. So again, with bonds or stocks even, you're pretty much at the mercy of the market and whatever volatility is happening. There's really not much that you can do, except for maybe you can purchase some options that might hedge your bet a little bit. But outside of that, really you're at the whims of the market. So for notes, what you can actually do is say your borrower gets into some trouble where they're having difficulties making their monthly payments, or they have stopped paying for a period of time. You can work with that borrower to potentially modify that note to see if you can adjust maybe the terms or adjust the interest rate, whatever it may be, to help them get back on track. Another benefit to notes over stocks or bonds is that you can partially liquidate your assets rather than completely selling off a certain percentage of your portfolio in the event of a need for capital. You could do something like sell off a partial or actually borrow against your notes to help you get the capital that you desire. Now again, this does have some similarities with borrowing on margin, which you can do with your stocks or bonds. But again, one of the benefits is that you're not at the whims of a brokerage account where there is that high risk of margin call that can occur if there's significant fluctuations in the market. Another benefit is that mortgage notes are typically going to fare better in times of inflation than a bond would, particularly when those bonds are only yielding a percentage point or two above the level of inflation. So the higher yields of mortgage notes help protect you in that regard. Now, you have to be careful with the terms of the note. If you purchase an extremely long dated note, like a 30-year mortgage note, you could still have some issues with losing value to inflation over time. But shorter term notes in the range of 3 to 5 years can allow you to adjust more quickly and reposition yourself as market conditions fluctuate. Also, the other benefit of mortgage notes is, again, they're backed by real estate, and during times of inflation, real estate values do tend to increase, and that serves as protection for your investment in the event that your borrower were to stop paying or get into trouble. Having that hard asset backing your collateral serves as a safety net for the investment. And you may again be asking, well, this all sounds fantastic, but in this case, why don't I just invest in the actual real estate asset itself? Why don't I go out and buy that rental property, get some tenants, and start enjoying the benefits of monthly cash flow in that regard? So of course there are benefits there. We've talked about that in previous videos. You get some tax benefits, you can get the appreciation. I do think it's a fantastic strategy, but it comes with a lot of responsibility, right? So you have to find the tenants, you have to deal with any of the maintenance issues, you have to manage the property, right? So there's the infamous 3 T's of tenants, toilets, termites, and you could add a 4th one, trash. Oftentimes you're going to have to deal with any of these or potentially all of these in a given rental scenario. And because your time is limited and valuable, that might not fit in with your goals. So even if you purchase rental property and get a property manager, there are still going to be things that you're going to have to deal with on your own. You're still going to get emergency calls from the property manager. So it's not completely passive. And so that can definitely eat into your time and cause more headache than you may actually want. So if you're looking to incorporate mortgage note investing into your portfolio for some of the benefits that we discussed to help kind of smooth out some of that volatility and get yourself some consistent income, what are the ways you can go about doing so? It depends on how much time you're willing to invest in it and how active or how passive you really want to be. So notes can be extremely active, but they can also be fairly passive depending on what approach you take. So one of the main approaches would be to go out and find notes and purchase them yourself. This is going to require the most time. You're going to have to take the time to go through the asset in fine detail, review all the collateral documents, do all of the due diligence to make sure that it is a safe investment that you're not likely to lose money on. A very good secondary option would be to look at note funds. So in these situations, you're going to be pooling capital with other investors. That's going to be led by a fund manager who will go out and acquire the notes, do all the work of the due diligence and actually servicing or managing the notes. So there's very little time commitment from you in these cases, and you don't need as much expertise or training to feel comfortable. However, there are potential for management fees. There's often limits or minimums for the amount of investment you have to qualify for these, so usually $25,000 to $50,000 to qualify. They may be limited to only accredited investors, so that's a very specific bar you need to meet in terms of either net worth or income standards. And you really need to know the fund manager. So in these cases, you can't entirely skip due diligence. You actually have to do a lot of due diligence on that fund manager, make sure that they have a good track record, that they are a reliable operator, because the last thing you want to do is give your money to someone who's just going to invest it and lose it for you. Now, either of these approaches I think can work very well in a taxable format. However, that's not really where mortgage notes are going to shine because they do not get very beneficial tax treatment. They are taxed as ordinary income. So in most cases, that means they're going to be taxed at your highest marginal tax bracket on the federal scale and potentially on the state level if you have a state income tax as well. So these do work extremely well inside of self-directed retirement accounts. That can be a solo 401k that you self-direct, or it could be a self-directed IRA account that you open. These are very similar to regular IRA or 401k accounts that you might have with a brokerage provider. However, they go through different custodians who really just hold the money and then everything else is up to you. You have to vet the assets, you have to do the due diligence. All you do is go and tell the custodian where to send or wire the money, and they make sure that you keep up on some of the accounting and other compliance. These accounts do require some additional education to make sure that you're staying compliant and don't get yourself into trouble with the IRS. And we'll plan to talk about these in more detail in future videos about how you might be able to incorporate the use of self-directed retirement accounts into your strategy. But I do believe that mortgage notes can be a fantastic option, especially as you get closer to retirement. And if you have a very substantial balance in your 401k or IRA, it might make a lot of sense to start looking at opening a solo 401k account if you're eligible, or a self-directed individual retirement account where you can move some of the assets from stocks and bonds possibly into mortgage notes. And that might help to deal with some of the volatility concerns that we've been discussing throughout this video. So with markets becoming increasingly volatile and stocks and bonds becoming more correlated and less of a hedge against downturns in each individual market, I think it's very important to start to look beyond those traditional investments and think about some of these alternative investment opportunities that we have. I think that notes offer a very compelling combination of high yields as well as the lower correlation to that market risk that we've been discussing. And it's also a way to get yourself exposure to real estate without some of the complications of actually owning the rental property or the hard asset itself. Now, I would say this isn't a complete replacement for traditional assets. I think a good balanced portfolio will probably incorporate both, but I do think it's valuable to look at this as an alternative or additive step that can help to smooth out the volatility you might be experiencing in your portfolio. If you enjoyed this content today and would like to see more videos like this, please like and subscribe, and please also leave comments below regarding how you're dealing with the market volatility that we're seeing right now. What's your preferred strategy and what types of investments are you looking at throughout the rest of 2025?